Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. Hey guys. All right, everybody, welcome back. Good morning, good afternoon. Hope you're doing well. New trading week, crazy trading week last week. So hope you guys did okay during all of that insanity. Got some interesting moves happening here as the market gets opened up. You've got NASDAQ pushing higher here yet again. This is just one of the most extreme examples in my trading career of sentiment getting extremely one direction and then completely beaten up on the crowd. It's something that you see happen in markets pretty much over and over, is the crowd sentiment when it gets really extreme. The market does an amazing job at taking money from the majority of people and giving it to a small subsect of people. It's a crazy concept. But yeah, I mean, Alan says Bears got squeezed, in my opinion, with premiums getting so high. I mean, Alan, straight up, yeah, that's you know who the winner in all of this recent volatility is? The market makers. So check this out. If you are somebody who trades or watches the options market at all, you know exactly what happened here. You had massive put and call buying. Now, when the VIX gets very high, what that means is that the market, like the crowd, believes that there is likely to be very large swings in one direction or the other. So when the VIX gets really high, what that's saying is that people think there's going to be a huge move higher or a huge move lower going forward. Now, market makers, people who short calls and short puts, which is something that I personally like to do. The beauty of that is that most of the time, the market moves less than the worst case scenario. And so if you were to, for example, sell people puts down here or sell people calls up here 1 week away or 1 month away, you collect a premium for doing that in the options market. Now, this does have relevancy to everyone here watching, so bear with me. But when everybody expects huge moves, the premium gets very expensive to buy calls and to buy puts. So last week, we saw puts and calls get very incredibly expensive towards the lows of this move. And so you had one bounce back for a week or so. One bounce back, and all those people who bought puts, who threw up, a couple $1,000s betting that the market was going to crash, that money got liquidated real fast, right? So when you have these scenarios where everybody gets fearful of a market crash all at once, historically, those are pretty good times to buy the market. Why? Because everyone expecting something oftentimes causes something to not happen in markets. It's fascinating how that works, right? When everybody thinks, oh, the stock market is going to go down to 4,000, when everybody thinks that, right? When everybody thinks it's going to go dropping like crazy, the market has an amazing ability to take their money collectively very quickly. And I am by no means saying that I knew this thing was going to do this, right? I didn't know we were going to have this sharp of a bounce. I didn't know where the bottom was. In fact, if you watched my videos, I bought the NASDAQ, tried to take a long position here, and stopped out. I also have been buying stocks since around this 5,800 level on the S&P. So I bought stocks, I bought more stocks, I bought more stocks, I bought more stocks. And I did buy some pretty heavily last week. I didn't know where the bottom was. And those are long-term holds for me. So it's not really like I can't really say, oh yeah, no, I knew the bottom was going to be right there. So I'm not calling that. But one thing that I've learned over the years is you don't mess around with a put to call ratio that looks like this. In fact, this might be an eye opener for some people out there. When the put to call ratio gets this extreme through history, it's almost through history. This is not guaranteed going forward, but through history, it's almost 100% chance that the market actually goes up. It's amazing how that works. People get so fooled into believing the market's going to crash at the worst possible times. It happens over and over and over. And I've seen it so many times in my career. You have people come on the live stream. Oh my gosh, Nick, you're an idiot. Why are you buying stocks? It's going to crash. You can get them 30% lower. And guess what happens? You know what happens to those same people? They're all in short. Then the market bounces. They get crushed. Then they say, well, fine. It looks like it's going to go up. I'm going to wait for a retracement and then I'm going to buy. And there's never a retracement. And the market rips and rips and rips and rips. And those people either hold on to their shorts until they blow up sooner, or they sit there and they say, okay, fine, it's bullish, but give me a chance. And there's no chance. That, do you know what that is? That is the mastery that the market has at taking money from people who believe they're so smart. There's an expression in markets that has resonated with me for so many years, and it has been such a pillar in what I do, which is bears sound smart, bulls make money. Okay. It did not feel smart to buy stocks into this move. In fact, I felt like an idiot. People were telling me, Nick, you're an idiot. And it doesn't mean we could go back lower. Like I hope we do, because I'd like to buy some more stocks. Like there's still stuff on my list that I didn't get to buy. So I hope we go lower. But every time this has happened, right? Everyone gets on one side of the boat. The risk reward gets too attractive, and I can't not buy that dip. Because nobody knows what's going to happen with tariffs. Listen, that's the reality. Everybody you listen to on social media, they'll give you, why there's so many people will sound smart. Bears sound so smart when you listen to them. Tariffs are going to completely disrupt trade, and we don't know. This could be a 10-year process of rewriting trade, and it could devastate global economies. That sounds smart, but it's oftentimes when bears get the smartest and they sound the best, that's usually the worst time to be a bear. Isn't that amazing? It's just rewriting your psychology with how this stuff works that will make such a big difference. Yeah. I mean, Alan, it was crazy. People who were bearish during this time, again, I just want you to think about why were you why were you selling in that environment? If you know market history, you know that has never been a good time to sell the market. When you get the VIX, go test this on your own. I encourage you. I've done the test myself. When the VIX gets over 40, most of the time, that's a bad time to try and short the market. When everybody's already convinced it's going to go lower, that's a bad time to try and short or buy puts or bet the market's going to go down. And we had a lot of people in the stream, but I know a lot of people who also have been in these streams long enough to know our playbook for that is to not panic, to not sell the portfolio just because you're seeing scary headlines, but to stick to a system, to stick to a strategy, focus on the fundamentals. The US economy does not look dire, right? Let's go look at the economic heat map. The US economy does not look like it's falling into recession as we speak. CPI last week was excellent, 2.4%. That's great. 2.7% PPI. Great inflation data last week, right? Jobless claims came in line with expectations. No freak out in the jobs market. Not at this time. You might say, oh, well, that's going to change. Maybe. But I don't really care what people's wild predictions about tariffs are. I care about the data because in 2023, you know what they said about you know what people said in 2022 about 2023? Economists, smart people said there was a near 100% chance that we would get a recession in 2023, and we didn't get one. My point with telling you that is that when you listen to headlines, when you listen to fear-mongering stuff all over the internet, they can sound really smart and tell you at the worst possible times when to sell the market or to short the market, etc. Pay attention to the data. I find that to be a pillar in what I do that's really important, is focus on what we can see coming in, not trying to make huge forecasts about the future. Future is really hard to predict. Economic growth in the United States, 2.4%. Okay. Inflation data came in really good last week. And jobless claims, not too threatening. We look okay. And so a baseline of we look okay, and also seeing that the Trump administration can be scared by what's happening in the markets is a good thing. They freaked out too. The Trump administration was like, oh my gosh, the bond market is freaking out right now. If we don't do something, we may actually have a problem here. And so they reacted. The Fed also seems poised to cut interest rates if needed. Powell seems willing to step in the event that you have a spike in unemployment rate. These are positive things. The news headlines don't tell you that, because that doesn't get you excited, doesn't get you to fear and click in their videos and like, look, on my channel I do a little bit of that too. But once you watch the video, you know I'm not here spreading panic and fear. In fact, I'm trying to do my best as a trader to not give into that stuff myself and to focus on what we can control. We can look at the data, we can look at sentiment indicators, and we can trade the markets based on stuff that just has worked, not headlines that are freaking people out, right? It's amazing how it's a system, it's a machine out there, right? The news media and the markets are a carnival. It's a game, right? Once you know the game, you can play the game correctly. But the correct thing is not to give in to, at least in my opinion, experience, and what I've done in the markets, don't give in to euphoria, don't give in to greed, don't give in to panic or fear. Those things get you in trouble. In fact, what the majority of people are doing most of the time causes people to lose a lot of money. So there's my rant. That's my updated view on markets. Look, I am bullish on the NASDAQ. I'm watching for this breakout. We've been discussing this for the last week and a half. Break here, pullbacks, looking for follow through to the upside. A lot of the stocks that I own are doing quite well today. I'm feeling pretty good about my Apple pick. I bought Apple last week. I'm up like, I don't know, 10% on the position or something crazy. Like, it really jumped. I think it was 12%, but it's probably a little less now with the pullback here we're seeing. Yeah, stocks looking really good out the gate here today. Apple, Tesla's up 3%, Nvidia's up 2.3%, Google, Meta, really strong start to the day. We'll see if it follows through. Again, from a indices level perspective, what I'm looking for is this move right here. Take out that kind of spike high day, that big short squeeze day. Let's see if we can actually take that out and follow through. I think if you have a lot of people who are bearish on this market are watching this level, right? And I would argue that bears are still overall still in control, but it's wavering, right? So if we get this scenario, break, retest, follow through, I like this trade quite a bit, and I'm going to watch for it myself. So that's a trade I'm looking at on the NASDAQ. I believe we're pretty close to a top setup score on the EdgeFinder. Let's see where we at. NASDAQ +3. Yeah, so if that trend flips bullish, we're going to have a bullish reading on the EdgeFinder for the NASDAQ. So that's a trade I like. What about Aussie dollar longs? Yeah, I mean, so on the top setups page, we've got some interesting stuff to go through here. You've got euro dollar, pound US dollar, the Australian dollar, Kiwi dollar. Look how bearish the US dollar is compared to most charts here. And if we take a look at the economic data scores only, and if I just look at currencies for a second, you can see it is very strongly tilted towards staying bearish the dollar within the EdgeFinder. So dollar yen, dollar CAD, dollar Swiss, these are getting negative scores. the Australian dollar, the euro dollar, the pound dollar, the Kiwi dollar getting positive scores. So for the currency traders out there, I am looking for more upside on things like euro. I took a profit on euro and Kiwi dollar last week. So if we get either kind of one of these guys on the Kiwi dollar, I'd like that trade for possible entry. Or if we reverse, if we actually go back down to these lows, I may look to start another position on the Kiwi dollar. So I've got euro dollar in my scopes. If we get a pullback down into like 1.092, pound dollar, kind of a wonky looking chart, but I would like a retest to this area, this 1.2750 zone. This area, I may start a position on that one. Australian dollar, similar to the Kiwi dollar, either a retest to those lows or a breakout above this 6,400. Dollar CAD, if you get a jump back up into these resistance points, somewhere in this region, I'd probably look to start a short position. So we'll see. We will definitely see. VIX is down another 12% today. And again, I think back to the NASDAQ for a second, you're really sitting at a decision point because you still could have bears come in and take this level. I am personally bullish if and only if we clear these highs and retest into this area. I know I keep saying that, but I have to clarify because I am bullish on equities overall, like stocks that I've bought. But from a trade perspective, like one of these, like a entry, stop, target kind of thing, I don't usually use targets. I trail stops. But from this kind of concept, I need to see this, right? You had kind of this higher low come into play. I'd like to see one more at a key level like this to give me the signal like, okay, we may actually have bulls back in control and we could start to grind higher from there. So I like that trade scenario, but waiting to see how we react at this level. S&P 500, if my chart would load, there it is. S&P 500, pretty much the same story, right? Resistance point here, would love to see this, do one of these guys. Just waiting. Lee says he's waiting on NAS as well. Yeah, just gotta see some breakouts here at key levels. I think it's a little preemptive, a little aggressive for me to get long right here. Just give me that breakout and I'll feel a lot more comfortable buying into a retracement. From a price action perspective, you got to think a lot of people who are bearish are like watching this level. They're like, okay, here we go. This is it. Sellers are going to take back control. What we want to see, if you're bullish like I am, is the sellers to get stopped out. And then the retest, that's what I'm looking for. I don't know that that's going to happen. That's just what I would need to see to get qualified into a position. How's your gold trade going? Yeah, so I'm giving back some on today. Let's take a look at down 1.16%. But I still like gold. I think it's you had a 3-day heat streak for gold. So we're seeing a little bit of give back on the day. My stop loss is below the 31.25 level of support. That's that previous level of resistance, now turned support, potentially, right? We want to see that level hold as support to stay in the trade. So what I'm also looking for on this gold move here is higher lows. So let's just say, for example, that we get this kind of move here. Like let's say we get a pullback and then we do actually end up doing one of these guys. What I'm going to do is I'm going to tighten up my stop loss further. Like I'm looking for, even if we don't go back, we might do one of these. Like this might be the low of the day. Let's just say we push higher from here. That would give me an opportunity to take this stop loss and to trim it higher. Basically now my point in this trade, I'm at the point where I'm simply looking for opportunities to continue to lock in more profit until it shows true signs of reversal. Okay. Sorry guys, my chair keeps going down today. So Yeah, that's pretty much on gold. I mean, I think it's due for some intraday pullbacks. But as I've been saying for a long time here, as a broken record almost, I don't think gold has to have some major sell off. Maybe it does if you get further trade, negotiations that go well. Maybe a huge catalyst for bears would be if China and the U.S. basically just shook hands on something. Gold would probably drop pretty hard, and I would probably take profits on my trade. But I still do think that even though trade negotiations overall will be okay, I think that there will be good news to come out of all of this. I also think that will take time, and that uncertainty, I think, in the meantime, will continue to support gold prices going higher. But we'll see. If we don't, again, I let price tell me when it's time to get out. If we come down, fail, I'll take profits and move on to the next trade. Peter Schiff believes gold. Look, I love Peter Schiff. I listen to his stuff sometimes, but there's never been a time I've ever heard him say something bearish about gold. So take that with a grain of salt. Right? When you're listening to people, and again, I like Peter Schiff's stuff. I think he's a very smart dude. But you do always have to take everything with a grain of salt when you're listening to commentators, because everybody has their biases. Like Peter Schiff he's a gold bull. He also has a company that sells gold, right? So of course he's kind of always going to be bullish gold. And once it hits 3,600, he'll say it's going to go to 4,600 and then 5,600. And see, like you do have to remember people's alignment. I'm not saying that Peter Schiff is, I mean, he's a very smart dude. So, I mean, I listen to his podcast pretty regularly. So, I agree with him for the most part. But you do also have to remember, like, predictions are, you have to be careful, right? Because I could say, like, oh, I think gold's going to go to 10,000. Someday I'll be right. So eventually gold will be at 10,000, almost certainly, on the US dollar. But it might take 100 years, might take 10 years, might take 2 years. We don't know exactly when. So S&P 500 giving back a little bit of its gains here this morning. Same thing with the NASDAQ. Dow Jones back under 1% for both of those in terms of daily gains. On the 4-hour chart, this is another thing. I may watch for a higher low on this. Like if that's the low for the day and we get something like this today, I may actually take that stop loss and move it right on up here. But I think it's a little too early to call. Like if we came down, like this is where you have to think about stop loss placement. It's really important. Like let's say we come down and test this area. I'm fine with staying in the trade because we might get this kind of reaction. So I don't want to just pull my stop loss up here because I might just leave money on the table that I easily could have avoided, right? There's pros and cons to everything. You might say, well, yeah, but Nick, your stop loss is so far away. What if you get this? Well, yes, there's no pain without, you don't get gain without no pain, right? That's the reality of trading. No matter what you choose, what strategy you choose, unfortunately, that's how trading goes. You have to pick something and you have to stick to something. So my thing that I pick is I trail stops, but I don't do so incredibly aggressively because I'd prefer to occasionally have this happen to me than to try and trail too tight and just get whipped out of a trade that I should have never exited, right? So if I'm really right about gold continuing, then I should see this sort of reaction. And if I'm wrong, then this will really tell me, okay, take profits, just get out of the trade, take what you got and move on. So yeah, that's the thought. We talked about this in the weekend video, the Sunday video, but there was something that really interesting happened, or something really interesting happened in the commitment of traders data this past week. So if you take a look at this, what we can see is that there was a big buy interest in US indices. Specifically, what I'm talking about is the Dow Jones, the NASDAQ, and the Russell. Big net buying occurring on the institutional level. Now, this shocked me and a lot of people. Like my Sunday video, it got a lot of views because we were discussing this, and I was pretty shocked by it. I was like, wow. So again, a lot of people were super bearish last week. A lot of people got really scared. We've talked about the put to call ratio 100 times on the streams. Everybody got really nervous about it. And then look what came out. Institutional money was in there buying the dip, right? So retail, the crowd, put to call ratio, everybody got scared. Remember that even if you're not an options trader, when the put to call ratio gets really high, that's a very bearish signal in this market. People are scared. People are selling. We also saw that in the AAII investor sentiment survey. Retail investors reporting significant bearishness. Like I've never seen it in my years of trading. I've never seen it get this bearish. Everybody convinced that, the world's going to fall apart, trade's over, it's terrible. And look at that. Everybody gets scared, and then we bottom out and we ripped like 14% in a week. In a week, that's insane. That's a good year for the stock market, 14%. So to get it in 1 week is just absolutely crazy. So again, people missed out on one of the best weeks that I've ever seen in the markets. In fact, it was the second or third best day, single day, that one big up day. That was the second to third biggest 1 day move in the stock market since World War II. I mean, that was a record setter. And most people were bearish into that move. So again, the market does an amazing job at doing this. It does an amazing job. I've been ranting about this all morning, but it's really important that you understand this. When the news is making you panic and convincing you that the market's going to crash, what's so incredible is that is so effective at removing people from the gains that are coming next. Now, it's not always the case, but most of the time through history, that is what happens. Like there's no certainty that the market's not going to crash. Like you never know. But when everybody's like selling you that the market's going to crash and convincing you to sell out of your portfolio or to get short the market or, take huge bets, it's amazing. That is an intentional machine, it feels like, to get people to panic, to sell out of their portfolio. And then a small minority of people who actually were smart investors, by the way, what we see in the COT data, right? Institutions buying in all that selling. Those are the ones who make money out of it. It's amazing. So you have people, panicking, selling their portfolio into the madness, and they missed out on the best day we have had in years on the stock market. Can you imagine if you sold your portfolio, you said, I'm done with this. I'm out of this. This is way too much. I'm going to sell it now. And because everybody's so bearish, like it's so scary, clearly we're going to have a crash. I'll buy it back when it's 10% cheaper. That's what a lot of people did. And then they missed one of the best days in recent market history. I know I keep saying this, but I'm hoping that this is resonating with people. And if this occurred to you, if you are who I'm talking about, I'm not trying to pick on you or make you feel worse about what happened. I'm trying to maybe make you think about this from a different perspective so that it doesn't happen to you again. That's the bigger picture. People I think I also am a little bit feeling like a little bit like I need to express this because the comment section of my channel was so ugly for like a 24-hour period. People are like, you're an idiot. There's no reason to be bullish. And people who were defending that thought process were the most loud about it. And they missed out on an incredible bounce. So the reason I keep saying it is because you can avoid those sorts of herd mentality moments. So what we see here is the Dow Jones, the NASDAQ, the Russell, net accumulation, right? That's the thing. We have to be really careful. So big money bought, retail crowd sold, and we can see it in the data. Again, you can't dispute this. This is not my opinion about This is not my opinion about what institutional money did. It's not my perspective. It's not me trying to interpret it from a candlestick pattern. It's reported by the CFTC what they did. They bought. It's amazing that, again, to watch it in front of us, we all just saw something pretty incredible. Sean, you are not ugly at all. You have an incredible beard, sir. I wish I could grow a beard like that. I cannot. Most I can do here is I can get like right around here. Like I can get that. You kind of see it. See like my shaded region, right? But I wish I could have a beard like yours, sir. You're not ugly at all. In fact, you're beautiful just the way you are. So anyways, long story short, right? Pay attention to your sentiment indicators. Pay attention to smart money, pay attention to retail money, and ignore comments. Ignore news headlines. Ignore again, I like to listen to some stations like CNBC and Bloomberg. I like to get some perspectives, but be careful with those things because even me, right? It's easy to watch those things and hear everybody getting scared on there. And for that to infiltrate the way your approach to the market is, ignore it. You'll be better off. It's amazing, right? How we saw such an amazing example of herd mentality get smoked by the markets all together at once. It was like in unison, the market's going to crash, and then it ripped. It's like crazy. So again, I know I keep saying that. I know I keep repeating myself, but let's learn from this. If you were on the wrong side of what just occurred in the markets, let's learn from it. Use our indicators. Use the institutional tracking tools that we've built. Use the put to call ratio to track how the crowd is feeling. Look at the AA investor sentiment. Look at the Bitcoin to gold ratio. These are tools. Use them. They set us in the right path in the past few weeks. Absolutely. Go back and watch through the videos. I was not perfect in the timing. I wouldn't claim to be, but we have been on the right thinking through all this so far. Now, with that line of thinking, we don't want to chase this either. Now that you've got the bounce, a lot of people are flipping to the bullish side. It's amazing how everybody went from, we're going to crash to claiming victory. Like, oh yeah, no, see, I knew it was going to go back up. That's amazing how we see that happening too in social media. So be careful with that. I think you can wait for so we had good inflation data, right? That was great. That was a good catalyst, but we need some catalyst to get us to break out of resistance. And then I think you wait for fear to come back in a little bit, right? And I think the risk to reward is really good for longs. That's my personal approach. That's what I'm going to be doing in this market. If I'm right, I'll look to make some gains. If I'm wrong, I'll stop out and take a controlled loss. What is the software? Good question. It is available currently 45% off. It's the EdgeFinder. We currently have a myriad of tools that we've built for traders to help spot these opportunities and to stay on the right side of what's occurring in the markets. If you don't have access to the EdgeFinder, currently we are doing our biggest discount of the entire year. It's a one-time payment to get access to our tools, and it is 45% off for a limited time. In the description or in the chat right now, if you speak directly to a member of our support team on our website, we'll get you that 45% off for a limited time. So here's the steps to get access to the tool. Step 1, click this link and send us a direct message on our website. If you're watching on a television or if you're watching on some device where you can't easily click a link, no problem. On your mobile, on your desktop, whatever, go to a1trading.com. And you can click in the bottom right, this chat with us icon, and you can start a conversation with our support team there and ask them about the sale. You can also just go to this promotional section in the top right and read about the current discounts that we're running on the tool. It's been 3 years since we launched this tool to the public. We have thousands of people all over the world using it and a dedicated team working every day to make it the best thing in markets for exactly what we're talking about here. Tracking sentiment, tracking economic data, focusing on the data, not the scary news headlines. I've been saying that a lot this year, and I stand strongly on that right now. It's a really important thing that you can always go back to. Like, that's the thing. Like, if you're somebody who's just like freaking out reading Twitter and watching CNBC, like you're unstable in terms of like what where you're getting your information. The beauty of a tool like ours is there's no political bias. There's no like headline bias. This is just the COT data. It comes in a text file and our software makes it easy to read. There's so much grounding that happens with that. That's the power in having tools like this. You're not reading headlines. That's so dangerous because it can infiltrate what you're doing in the markets. You're like, oh, you know what? My system usually tells me to take a trade here, but let me just wait for this, right? Ignore it. I'm telling you, the second you move past the headline phase of your trading journey, things start to happen because it's really easy to fall in that pattern. Has anybody fallen down that trap? I know I have. If you've been in the past negatively impacted by news headlines, or maybe somebody out there will be very honest about this and tell us that maybe last week you made that mistake. Share it in the chat really quick. Has anybody made that mistake before? Like, has anybody freaked out because of the headlines? And maybe if you want to share it with us, did that happen to you last week? Did you fall victim to that machine? You're not crazy if that happened to you. It's designed like that. It is designed to get people fearful, watching the headlines, sell their portfolio, right? I think that stuff is real. I think that there is a real concerted effort for the news lines to freak everybody out and to allow a minority of players in the market to take the majority of the chips off the table. I don't even know that that's really a conspiracy theory. I just think that's straight up happening. Still, I don't know what software to use. Okay, you can go to our website, a1trading.com, a1trading.com, and you can explore the EdgeFinder right here. Or you can click View Our Products, EdgeFinder. That's where all the data that we're building can be purchased from our website. There you go. Thank you to the producers for dropping that link. If that's easier for you, find it there. If you have any questions, chat with us on the site. Oh, yeah. Googling JPY news and immediately buying or selling depending on what it says. LOL. I did that for about a year. Anthony, totally fair. Look at this, web trades. Good to see you. Good to see you, man. When I started, I went all in on a best stock to buy this month. Then it went to zero. See, that's what I mean. Articles are dangerous. Headlines are dangerous because, tariff news made me exit my gold trades early. See, there you go. Sign of recession, but I don't think the time is yet. For me, I'm preparing for the next year's crash. I'm thinking maybe it happens. I just think that the thing with tariffs is there's a lot of talking heads that will make you believe they know what's going to happen with tariffs. When the humility comes in, you say, we don't know for certain what tariffs will bring. Do they increase the probability of a recession? I would say yes. Most intelligent investors on Wall Street would say yes as well, because they introduce uncertainty, right? But that does not mean a certainty that we're going to have a recession either. It just means there's a rising risk of, we could see recession if we enter into a prolonged trade war. Doesn't mean that's what's likely to happen, right? I would say that this is just my best guess, and I'm certainly not like a Nobel Peace Prize winning economist, so don't get me wrong, but I think there's like a 40% chance. I think that the market is saying like an 80% chance, or it was. Now it's bounced back and people are, not so freaked out, but they still are, right? There's still a high level of fear. Oh, this is painful. I went all in on a stock and it was the quote unquote best to buy. A few days later, it got delisted from the stock market. That's rough. That's rough. Do you have an updated video of the EdgeFinder explaining all of its data and features and functions? Actually, yes. It's on the homepage of my YouTube channel. So if you go to my YouTube channel, Trader Nick, you can find a full latest video. I think it's also available on our website. Let me just check because I'm curious. Okay, go to EdgeFinder tutorials. And here it is. Yeah. So edgefinder.com/edgefinder-tour. You can watch the full video there. After the live stream ends, I would highly encourage anybody who is curious about the EdgeFinder, spend some time in this. Head over to a1trading.com, go to tutorials for the EdgeFinder and explore its features. Read about the institutional data, how we score things. I encourage you, take some time. If you're considering the tool, I would rather you take time to read about it, make sure it's right for you. And don't buy it unless it actually seems like it would genuinely benefit your process of analyzing the markets. Is a sale still available? Yes, it is. It is ending, what's today? The 14th. You have like 2 weeks left. It's going through April. So if you don't have the EdgeFinder, it is the biggest discount that we do all year long. If you've thought about getting it, do it because it's the best time of the year to get it. It's the lowest price we go. 45% off if you're watching the stream right now. It's 40% off, but we do extra discounts for people who are streaming with us, watching with us live. And like I said, you can chat with us on the website to get that extra 5% off. Still watching NASDAQ, 1.3% up here today. Dollar index flat for the day, nothing too interesting. Gold pulling back. Like I said on this one, I'm just trailing my stop. I would imagine that if we pull back into this area, that we should see buyers step in. But if we do not, I'm going to take profits on the trade. So that's how I'm playing gold right now. Nick, are you interested in JPY pairs? Yes. Dollar yen. So dollar yen looks interesting to me on the short side. We have some pretty strong. Wow, look at this, guys. I did not recognize this. Japanese yen took the #1 spot on bullishness for the COT data. COT data history. Let's look at Japanese yen for a second. This is incredible. Look at this. The Japanese yen went from the most bearish on the EdgeFinder's COT tracker to now being the most bullish. That's amazing. Like it changed pretty quick. Like once institutions decided they were going to be long Japanese yen, you can see, well, actually I take that back. Not quick for retail, but quick for institutional money flows. You can see once institutions decided they were getting long Japanese yen, it happened within like a 6-month window. But that's how institutional players do it. They accumulate and distribute over large stretches of time that retail does not usually operate within. Like retail traders are not usually buying something over the course of 6 months. Does anybody do that? Does anybody? Well, I guess, I mean, I do a little bit of that in the form of dollar cost averaging. Anybody accumulate like that, like over like large stretches of time? I know one very popular way to do that is you have a list of stocks that you like, or maybe it's gold, or maybe it's silver, or maybe it's the index, whatever you do. Like a lot of people will invest regularly into something. Like they will, that seems to be like how investors on the institutional level seem to move. So we can see by looking at the Japanese yen, which we've selected in the top right here, we've selected JPY. So the Japanese yen, they've been building a position long. See this yellow line, right? Long percentage. That line is moving up over time. But you can see it's not happening all at once. It was happening very quickly during that August freakout that we saw last year. Then it paused and now it's jumping again. So we see institutions accumulating more Japanese yen. Bullet says my main strategy for crypto, Nick. Very nice. Yeah, something to think about. Sean says, are you still in TLT? No, I'm not. I'm out of TLT. I took a lot of those funds and bought stocks with them, which I'm glad that I did that. I ended up pretty much closing out the position TLT to take those funds and buy things like NVIDIA and Google and Meta and all sorts of stocks that I like for the long term. Yeah, so very interesting. Oh, man, guys, you ever wake up and you're just like, I totally slept wrong on something? That is me right now. I woke up, I knew I was sleeping wrong because just like you know when you like wake up in the middle of the night and you're just like your head's like off the pillow or something, you're like, oh, I just know I'm gonna wake up feeling that. That's me today. Starting to buy very, very tiny. Yeah, I mean that's to me when I dollar cost average, that's the way I do it, right? Is I do very small position sizing because markets can be so crazy. I had actually a conversation with Chris Pulver in our office. He physically stopped by, hung out with us for a day last week, Friday, and We sat down and we did like a podcast together. And we were just talking about some of our most nightmarish examples of dollar cost averaging. Because dollar cost averaging, guys, let me tell you, it can get ugly fast when you're on the wrong side of something and your sizing is too big. So for me, I tell this story pretty often. My nightmare story in dollar cost averaging was with the euro against the Australian dollar in 2020. I was short the euro against the Australian dollar. And for a long time, I made very good money doing this, right? So I'd short it, take profits along the way, long, take profits, short, take profits. You know, I did this very profitably for a while, 2019, 2020. Well, 2020, volatility expanded. The VIX went crazy. And this is why I always say the VIX does not just pertain to options traders. It pertains to everyone. Forex traders, crypto traders, commodities traders, doesn't matter. The VIX matters to everyone because the VIX expanded like crazy in 2020. And this is what happened to the euro against the Australian dollar. So again, I was making great money trading back and forth, dollar cost averaging, taking profits, dollar cost averaging, taking profits. Look what happened in 2020. You tell me how you think I did in that kind of move, dollar cost averaging without a stop loss. Nick, you idiot. What were you doing? Well, I actually had small sizing. I was doing it with small size. I had 0.05 lots per trade. So I was 0.05, 0.05, 0.05. And I was trading for the reversal. I still do this to this day. You might say, Nick, you're insane for still doing something like that. I still do it. But let me say that this humbled the life out of me because it showed me I need to go back and watch these streams from these times because I was not okay. Like mentally, I was like, holy crap. I thought I was being defensive. And I ended up doing okay with this trade. I actually ended up closing for like a couple $1,000 profit in the end. But oh my God, did I have to earn that? It was absolutely painful because what happened during that time was that when the world was planning to shut down, the Australian dollar, in a scenario where the world shuts down, is not a place to be because they're a commodities-based economy. So if they're selling, iron ore and copper and all that stuff, and then the world shuts down, that's not good for the Australian economy. So the euro massively jumped against the Aussie dollar, and I rode that baby. But the only reason I didn't blow up is because my size was tiny compared to the trading account I was working on. By the way, just when you think 0.05 lots, you think that's a small size position? If you had talked to me, I wasn't in a very good mood at that time. And I can tell you that ain't a small position when the markets are moving like this. It's all relative. That's why the VIX matters. When the VIX is really high, a 0.05 lot size can be a huge position and you didn't even know it. So I learned a lesson during that. Like I survived that and I didn't ever get past my point of no return. Like I do have, when I dollar cost average, I have like a 40% drawdown like limit in my aggressive Forex account. Like 40%, if that triggers, I'm all out. I think I got to like 29 or 31%, somewhere in that range, peak drawdown. And I was like, yeah, if this keeps going, that is going to have to be, I'm going to have to basically wipe away all the gains that I've made in the last like 2 years. And that's going to suck. But it didn't happen. The market did ultimately reverse and I was able to get out. But 99% of traders would have been too big and would have blown up way sooner than that. So it just is the importance, if you're going to dollar cost average, what you think is a small position may be a very large position. Even 0.01 lots in a certain currency pairs, like Euro Aussie is not a joking, that's not a currency pair to play around with. That thing is very volatile. Like even this move that we're seeing now, it's a 2,000 pip move. So choose the correct currency pairs. If you're a Forex trader, choose the correct lot size. If you're a NASDAQ trader and you're trying to dollar cost average, I really think you probably shouldn't be trading on a CFD brokerage. You should probably trade trade like ETFs That's my personal opinion. If you want a dollar cost average, QQQ is a great, it only takes $461 to buy a share of this. So you could theoretically buy one share for $500. You're $500 in, buy another share at $400. That's $900 total invested. That's a $900 max dollar risk, right? If the NASDAQ were to go to zero, which if the NASDAQ goes to zero, we got way bigger problems than trading. Like the world probably ended. So just something to think about. Had a comment from Bulent. I want to make sure I get to this. Basic logic is this. I don't care about taking profits before a serious decline. I always buy according to 80% pullbacks. How much I will buy is clear from the beginning. Then I carry a take profit. Very nice. Yeah, I think that's like a good, and that's very conservative, right? With Bitcoin, if you're waiting for 80% drops, you might have to wait quite some time. But again, we know through history that Bitcoin has a tendency to have those very steep declines. When doing long dollar cost averaging, if it falls by 50 to 80% at most, but carrying a short position is incredibly risky because there's no limit to the upward movement, infinite. Yep. Little different when we're talking Forex, because typically Forex, long or short, over the long stretch, most currency pairs move sideways. Like if you take a look at the euro dollar, like think about this, we're trading at the same place we were trading in 2016, same place we were trading in like what, 2002. Like the currency pair over the very large stretches of time doesn't actually move that far. It does, but like that's the thing about currency pairs. It's a little different than perhaps like Bitcoin or gold or indices. They're two unique, different types of markets. Just something to think about. But anyways, back to this Japanese yen concept, which by the way, dollar cost averaging wise, the yen pairs are probably the ugliest candidates. They move so much. So you better have a really good size trading account if you're going to try and dollar cost average on yen pairs, because they move like a monster. Dollar yen would be interesting on a pullback to me. Looking for a short side continuation on this. Let's take a look at what's happening with the dollar. I'm curious. So dollar, pretty mixed here, but you can actually see a lot of selling happening in recent filings have actually been pretty net bearish on the US dollar. We saw that this past week. Take a look at US dollar. Pretty good selling that took place. A lot of long contracts getting closed. Also short contracts getting closed, but think about it proportionally, much more longs were closed than shorts. Very, very interesting. Yeah, but dollar cost averaging is a controversial topic too. It's controversial because dollar cost averaging usually entails not having a stop loss, which is like a big no-no for many traders, which is, I think, for most traders, you probably should use a stop loss. I use a stop loss for my momentum trading strategy always. Like for example, like gold, I always have a stop loss on gold when I'm trading it, because I'm looking for momentum to continue and to get out if I'm wrong. But dollar cost averaging on, like for example, a stock that I like, the risk to the stock or the risk is however much money I put into the stock. So let's say that I put $10,000 into NVIDIA, right? Through the course of dollar cost averaging. Let's say I bought some here and I bought some here and I bought some here and I bought some here, and I'm all in for 10K. Well, if this stock goes to zero, then I lose 10K. That's how much I'm risking, right? But if I'm right about the stock moving higher and it goes and this doubles over time and it goes to 20K or 25K or 30K, then I do really well with it, right? So when you're dollar cost averaging, you still need to acknowledge what your risk is. I think the only thing that's foolish is when people don't have a stop loss and they don't they don't even know what their risk is. Like they're just like, you see what I'm saying? Like some degree, like if I'm doing it in Forex, I mentioned having a max drawdown that I'm comfortable accepting within the portfolio. That's something to think about too. Is dollar cost averaging suitable for a day trader? Yes and no. Like you could dollar cost average on a low time frame. The same concept applies. Like let's just say you think the euro dollar is going to continue higher, but you're looking to buy it here, you're looking to buy it here. Like maybe you do that. Still same rules apply though. Like if you're wrong, what are you going to do? Like you can't just say, I'm just going to dollar cost average into oblivion. And if the account completely, because what you have to say with dollar cost averaging is you have to say like what your max pain level is before you have to close everything out. And so for me, I've mentioned like an aggressive Forex portfolio. For me, that would be like 40% drawdown. So how do I survive? Tiny positions, really small trade here, another really small trade here, another really small trade. I'm talking 0.01 lots, like for good sized accounts. It's not very glamorous. You're not going to make money quickly, but you guys know on this channel, that's not what we're about. We're about making money sustainably for the long term, not trying to double it tomorrow. So that's how when it comes to dollar cost averaging, that's my approach. Really slow and steady, really boring stuff. Like the key to being a dollar cost averaging type trader is it has to be so boring that you hardly think about your trades. That's the only time I think you're actually positioned in a way that you're not going to blow up. I'm talking about 0.01 lots on a 10K account or more, depending on your risk tolerance. But biggest thing I could encourage if you want a dollar cost average, back test some of the craziest times. Define a rule set and put yourself in January of 2020 and test it out. Okay. You can use the replay function. You can use Forex tester, but I would encourage, if you want a dollar cost averaging, if you want to try that, if you want to learn about that, demo test, because again, dollar cost averaging is a huge way to blow up a lot of money if you don't know what you're doing, because it's all about position sizing. Dollar cost averaging, the name of the game is position sizing. It's the only way you survive long term. If you're, again, I told the story, the Euro Aussie trade, had my position sizing been any bigger, I probably would have had to close everything out and taken like 2 years of my gains and wipe them off the table. I didn't have to do that because my position sizing was small enough. But even what I thought was small ended up being kind of still too big for my own comfort level. So it just goes to show, just test things out before you do them. A lot of traders just see a YouTube video and they're like, oh yeah, no, I'll do that. That's going to work. Don't do that. Test stuff. You have to put in the work. Guys, the EdgeFinder sale is ending soon. If you want access to our COT data, retail positioning data, put to call ratio, Bitcoin to gold ratio, all the different tools that we build for traders, this sale is ending very soon. You can currently get it for a massive discount, 45% off for a limited time. If you want information about that, find it in the description down below this video, or head over to a1trading.com if you're watching on a television or somewhere where you can't get to the description very easily. And finally, if you're watching with us on a mobile device or a computer, click the link in the chat right now to speak directly to a support member of our team who can get you that 45% off discount while the stream is live. Okay, guys, up next, we got Chris Pulver taking over the show. Stay tuned. He's coming in just after this.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else, and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. What's happening, everybody? Happy Monday. Welcome back. Let's have a look at where everything's at today. Volatility index. So some of the crazy extremes we saw last week. I want to say it was the third largest VIX move. The largest like 4-day move we've had, I think top 3 goes back to 1987, which there wasn't a VIX, so nobody knows what the VIX was at that time. But 2000 and 2008 would be some of your largest VIX spikes. 2020, one of your largest VIX spikes. But this was the fastest VIX crush in a single day. So when we got up here to 60, and then had one giant day, and it was not this Monday, but it was Wednesday. That Wednesday surge, when the official delays were announced or the 90-day window was announced, that Wednesday VIX push to the downside was the largest single-day VIX crush ever. I don't think that this market is done. I think there's going to be a lot more volatility ahead. News over the weekend looks like we have some windows where there's like in the tech space. What I read this morning, it was tariff carve-outs don't mean reprieve. Investors should know that the new tariff update comes with a wait and see caveat. We have exemptions for smartphones, semiconductor chips, and other electronics from the reciprocal levies. It's meant to give companies time to do production in the U.S. So Apple, Nvidia, and other tech stocks hopefully get this for Nvidia trading higher. That's kind of the big lift for the market today. S&P is up. We had a big gap to the upside, about 1+%. So I think that, look, the market right now, based on this kind of bullish seasonality, a little bit of this 90-day window, the market caught a little bit. And this is either setting up for some type of bullish pattern where maybe the market does in fact break highs, or this is just all the drama, a relief rally, and then we have more chop. The bears could, work their way back down into ugly levels. We could revisit the lows again, which I think investors are genuinely concerned about. This all happening in the wake of earnings, which we had earnings just kick off last week of financials. We have more this week. Let me show a screenshot of what I have for earnings. So this week's earnings, some of the notables, I would say Johnson & Johnson, kind of not related, but what's going on in the healthcare space, because we had pharmaceutical tariffs coming in, that was hitting Johnson & Johnson really poorly. The last week of price action, more financials, Bank of America, Citigroup, PNC, grocery stores, kind of the sign of the consumer. How are they doing? Tight margins in grocery stores. Equity bank shares. We've got, let's see, transportation. That's going to be an important one to watch. Again, not a super volatile stock. Interactive brokers, traders in general. CBOE stock does pretty well. United Airlines, super sensitive since we've had a couple of crashes and then, worried about growth concerns. Bank of America. So just a lot. I mean, we're just getting started. Earnings season just getting underway, and it's a lot in the financial space. Here's more financials. Here's Bancorp, Abbott Labs, Progressive Insurance, Travelers Insurance. I'm sure they're going to do just fine since they've upped their price policies by 50%. Citizens for financials, First Horizon for financial. That's regional bank stuff. Alcoa, that is your aluminum maker. You got banks, more banks. Thursday, United Health Group, more banks, Huntington, consumer, American Express. Let me take a look here. So I have a trade running on AXP. I think it's out to May, or it's maybe I did it out to, let me check AXP. I know I have positions on AXP. I think it's out to May though. AXP. Yep. So I've got we're trading at 255. I have a 260 by 270 for AXP. I'm hoping that earnings are positive enough to give this thing a boost, have a nice window. That's, well, fingers crossed. AXP for American Express. It's behaving a lot like the S&P, showing some divergence to the downside, getting back into this chop between like the 270, 275 handle. I closed out the April ratio spread for profit. Now I have the May one. If we push up into the 270s, this is probably looking good for profit. I'll protect. I already took profit this morning on Microsoft and Coin. Had a couple day trading winners on SPX. So this is another opportunity to hopefully be de-risking the portfolio, adding some gains, and getting more buying power back. I was at around 900,000 last week. Now I'm back to 1.2. So when I'm taking profit, I'm getting buying power back. And I want this to hopefully climb back up to like 1.4 to 1.5 cash in order to have more buying power to properly position for the next 6 months for the rest of the year. Not messing around, man. This market, if it's going to do some silly things and we're not going to make all-time highs, I've got to be playing a lot of defense. So I could see this market coming back into this 5,500 zone in the SPX, maybe 55 to 5,700 zone in SPX, and from here, lots of reasons for the bulls and bears to fight. If you start lining up negative earnings, you start lining up concerns that the Fed is not going to cut rates as aggressively as they plan on this year. If inflation data is not improving, if the bond market is continuing to struggle, which is what really last week was all about, in my opinion, this was the bond market. So you look at the U.S. 10-year, we're starting to fade a little bit, which is encouraging, but this is still higher than where we were during Liberation Day, right? So this whole idea that hey, we're celebrating the 10-year below the four handle. Well, it's not. Now it's at 4.4. So this is the way this whole thing was rolled out, and the way that the markets took this with price action. It's all been a disappointment. I mean, getting below the four handle was because the market was capitulating lower, and we had a 12% drop in 4 days. We were 20+% from the peak, from the highs to recent lows. And between the S&P down 21%, the NASDAQ down over 27%, yeah, it makes sense that the yields were dropping because the markets were planning on the market going into recession. But that all flipped on Wednesday, and yields did the exact opposite. So yields are up and higher than they were during Liberation Day when the administration was celebrating. We're going to see if things can settle down a little bit. The TLT, your 20-year bonds, also dropped almost, I think it was like 8%, maybe more. That high to low move was 9.5% in about 5 or 6 trading days. So this is why I think the market reacted on Wednesday the way that it did. This is why I think the 90-day pause happened, is basically the U.S. was seeing that the bond market was breaking right in front of its very eyes. So if they didn't do something about that, and again, like, it's not like TLT is ripping to the upside. It's just it's stopped the bleeding, and we're sitting on a 40+% drawdown for the last 4 years in bonds anyway. So this has been a terrible asset to be in. And if you're going to force your foreign holders to sell treasuries, possibly just to focus on buying gold, this has been part of that kind of layer. And then the other one would be you're blowing up hedge funds, and they're getting rid of what's called the basis trade, and they're just de-risking and deleveraging. And if they're holding bonds and duration, it's not helping them. So anyway, big turnarounds, lots of volatility expected. I think right now, based on the seasonality, we do have earnings season. Considering the market is off the lows by a reasonable amount, I don't think it's as doom and gloom as what it would have felt like had we come into earnings season back at 4,800 or 4,900. The fact we're back up to 5,400 maybe makes it seem like it's a bit more contained for right now. There's still a lot of risk out there. There's still a lot of uncertainty out there. And I mean, I don't think anybody said 2025 was going to be easy, but it has certainly proven to be a lot more difficult and a lot more volatile than I think most traders expected. So it is what it is, right? Let's take a look at currency strength. Right now, we are getting Swiss getting weaker. That's a big cha-ching for some of those turnarounds we've seen. I'm going to log into my Oanda portal here and see how some positions are doing. So we have New Zealand and pound on top. Aussie's up there as well. A lot of things at baseline, but Swiss is getting beat up. That's a nice little run. I mean, 140 negative on the currency strength chart means that we've got about a 200-point swing in New Zealand Swiss, which is kind of nice to see. Let me check on a few positions here. So I'm just going to look at some of my positions. CAD Swiss is looking okay. Aussie Swiss is looking okay. All right, so I'm going to start shifting those around, getting some buy stop orders in. Aussie Swiss. CAD Swiss. Yep, I'm just going to move. I'm going to shift some buy stops lower and see if we can start climbing our way up. Euro Swiss looking a bit better. New Zealand Swiss. Nice little turnaround there. Okay. Yep, so I just have some work to do on all of those. Dollar Swiss, fine. Bought in at the lows around 80, 8,400. All right, I'll keep a close eye on that. But Swiss getting weaker is nice. Let's go through the indexes here. S&P is up around 1.3%. You got the SPY up 1.5. Mags are coming back a little bit more. There's a gap higher today on Mags. So not too bad. Volatility index is probably going to be the big story. If we continue to revert, usually this takes about 4 to 14 days on average to return to normal. So spiking up here, this is also why I was selling a bunch of premium. It wasn't fun. Definitely had some close calls, but this week's expiration should allow me to hopefully grab a nice chunk of profit and I get a bunch of buying power back, and I can, kind of remain sitting on the sidelines with some dry powder, position for anything that I'm kind of looking at resiliency and bullishness on. It's out to like May, June, July. July 9th is the 90-day deadline in tariffs. We get out of July trading and it's August, September. Now we're talking September is when the federal layoffs hit the markets. So all your federal workers that are getting laid off, they're going to have to go and seek private sector jobs by September or something. And September to December could be a very big window for federal unemployment, for private sector jobs as well, non-farm payroll, and whether or not we start to see the unemployment rate in the U.S. tick higher, jobless claims starting to show upticks. That would be that potential, like, okay, so all this has been, there's no stagflation, there's no recession. Why? Because people have jobs. Labor market data remains pretty tight. If that starts to get looser, September, October, November, December, then we could still roll over into a recession. The market may not make like aggressively lower lows, but we could still roll over and have some threats to the downside. So let me see how my SPXY is doing. I bought SPXY this morning. Should be up around 50, 60 cents right now. See if I can get a chart alarm here around like 39. Set a chart alarm there. I'll be up about 300 bucks if I get that trade heading back up into that gap fill. I'm going to see how big of a squash we can have an SPXY this week if VIX goes down. So S&P is up. NASDAQ outperforming, up about 1.8% on Qs. NDX up 1.7%. Dow's up over 1%. Russell's up over 1%. Volatility index dropping fast, 1-day and 30-day. Dollar index oversold conditions with divergence. So just be on the lookout for maybe a fake out on the dollar. We did break the lows from September 2024. We also breached the lows from summer of 2023. Look, if you want to continue to short the dollar, any pullback, look for opportunities to sell on smaller time frames. Okay, if you're looking to buy the dollar, let this thing kind of settle in. Look for some type of falling wedge. See if you get a squeeze trade. This is still very resistant on the outer trend line. So anything at this outer trend line with the dollar, bears are going to still want to sell the dollar. If it stays on the left-hand side of this trend line, bears are going to sell the dollar, right? But going straight down, this is not the time to be selling. So either we have a break, pullback, and another sell-off, or break sideways and a flag and another sell-off, or a pullback into, let's say, this candle, similar to what we had right here, just a little pullback, right? And then see if this resumes selling. If we're breaking these lows, we're going to fresh lows. I mean, again, how low does this dollar go? I have no idea. Maybe it does, maybe it doesn't. Because based on the last couple of years, the dollar has been pretty sticky around that 100 handle, and we're trading at 99.60. Last time we did that, it was a bear trap. So is this another one that's a bear trap? We're seeing oversold conditions with divergence. So be careful on shorting the lows on the dollar. That's all I'm saying. Oil. Oil, honestly, I don't know. Oil might be in a good spot for like a strangle trade. Let me see what the IV is on oil. Maybe it's a strangle trade. I don't know if I'm going to love this trade or not, but let me see what CL offers up. If I went out, let's say 30 to 60 days, maybe 30 days. So on the call side, could I sell above 65? Yeah, maybe 66 or so. See what those deltas are. So I could do a 67. That's a 20 delta. Let's let this update here. Okay, I'm going to go 20 delta and see what this looks like. 55 by 54. All right, let price update here for just a second. So I'm going $1 wide. I should be able to pull in maybe $2 for an iron condor. So if I'm risking like $2 to risk 8 to make 2, maybe. I don't know why this isn't updating. I just have to let these prices update. I'll come back to that in a second. But 60, what are the two levels? 67. Okay, so 67 is up above this, what was a long time support level. 67's up here. The floor is at 55, and my low's around 55. So if we're putting in a bounce, that could be a good spot. We're just off the lows, we're off the highs. I would just call this center, right? If this is center and price is just going to catch its breath for 30 to 40 days, then an iron condor, or a lot of traders like to do strangles. Personally, in futures, I don't like to do strangles. I think there's way too much risk if you have an outlier type move. So I'll stick to an iron condor if I can get like 20 to 30% of the width. See if this gets any better. I'm still not getting any freaking deltas updated. That's annoying. All right. So anyway, I'll just wait, but that's roughly what I'm looking at. So I'll write this one down. This is a CL 67 by 68 and a 55 by 54, and just see what it's offering. So I'll come back to that one. Okay, natural gas. I'm still long to 2027. Gold, we've stretched out officially, I think, the 20%. Nope, 16.5% from the 200 moving average. Again, not calling the top in gold. If anything, though, just be mindful of this. Having overbought conditions with divergence, overbought conditions with divergence, overbought conditions with divergence. This could be the exact same thing. I'm curious on one of my other workspaces here. If I go to, let's go vol squeeze, mighty macro, maybe check some macro. Okay. So what I see on a couple of things. We have highs in price, lower highs in relative strength. That is hidden bearish divergence. Money flow, as we're making a fresh high in price, money flows are making lower highs. So I do see some divergence here. Again, not wanting to say that the top is what I'm trading in gold, but expecting a dip or a pullback, right? I don't know. And look, this is a bold claim here. I don't know what it would be. Okay. I don't know what it would be to bring this down to the 200 moving average. But I will say that if it happens this year, if we have a crash in gold that gets us down to this 144 to 200 moving average, this is why I'm intentionally keeping dry powder. Okay. I don't know what that would be. The U.S. might have to do something really disruptive and say, hey, look, we're going to sell gold so we can do this in our bond market. We're going to sell gold so we can do this for Bitcoin. I have no clue. But something that would be a bit of a V bottom crash type move on on gold. The only thing I could relate back to would be like the crash during 2020. This thing just spiked all the way down to it and then came right back out of it. Right. Otherwise, I mean, we've had like pretty good stretches and tests of the 200 moving average, but the last time we touched it was way back here in October of 2023. So we are pushing a bar count of around 384 bars. That is a lot. Okay. I keep repeating this, but it is literally why I was short the market this year, because these bar counts are over 350, 360, 370. We had Meta up to like 600 bars. So I'm not saying that it has to guarantee a top, but I'm saying that it makes me uncomfortable buying these highs when it's such a good technical short. So I just want to see the market satisfy the need for this correction, and then I can buy and reestablish a trend. So just don't be surprised as we're making higher highs if there's less and less volume and momentum going with it. Especially if the markets have settled down, it seems like there's a less of a safe haven appeal, at least in the near term. that maybe the equities markets are getting some lot of rotations. I mean, we have a lot of rotations going on. There seems to be some broken correlations, lots of ins, lots of outs, inflows, outflows. There's tons of stuff going on right now, and it's making every trader pay attention. So it's not going to be easy. Obviously, if you're long gold, you're probably fine, but just be expecting. I'll just throw it out there. If you're long gold, okay, if you're long gold and this thing pulls back, 15%, don't be mad. Right? Just if you buy gold now and it pulls back 10 to 50%, don't be mad, because that's what I expect. If it goes higher, fine, easy. If it goes higher, nobody complains. But if you're going to like dollar cost average, if I bought gold now, I would say, okay, well, that's area 1. I buy gold at this recent low and I buy gold at my technical support. So small, build this core position up, and this is my break even on this chunk of shares or chunk of investments on gold. And if we make higher highs, well, then I would be sitting with an investment that has the ability to make about 9%. Okay, that's a safe haven. 9% up is a lot better than the markets being down 10% year to date or 20% from high to low, right? So anyway, just keep an eye on gold. I think it's reached some overextended conditions that I'm cautious of. I'm not shorting gold. I just want to see if we have some pullbacks. Okay, silver responding really nicely off that low. I've got SLV positions, SI futures positions. Copper's looking a lot better as well. Bitcoin certainly looking better off the lows around 74. If we have enough time on Bitcoin going to the right-hand side of the trend line, maybe making a run back up towards 100 plus, but this has to be some bull market resemblance as well. BITO, IBIT looking better. I've got some expirations this week on IBIT. MicroStrategy back up above $300. I've got a covered call at 310 that I will look to see if I want to dump the shares, take the profits, move on. Coinbase, I took profit on Coinbase this week. This is 225 credit. I closed it out for a close for a 0.05 debit. So 225 credit, close it for a 0.05 debit, taking majority of the profit. Ethereum, I still wouldn't touch Ethereum yet unless we're on the right-hand side of the trend line. Copper, all the way back up to 4.5. The 24th, I have expirations on copper, but if I'm in profit, it may be worth looking at here. I still don't have data on these stupid CO contracts. So dumb. All right, I'll come back and revisit that one. Let's go to copper. Copper is now up $750. Still a little bit more time in the trade. There's a lot of volatility here, but I need copper to stay above 4.18. So the option chain right now, 4.18 is way out of the money. We'd have to have copper dropping to an 8 delta. So right now there's about a 91 to 92% chance it stays out of the money based on option prices and normal volatility. If volatility goes down, VIX goes down, copper's probably in a good place for me to make full credit by the 24th. And that trade is going to be worth around $2,000. So it's worth, for me, just worth kind of hanging in there and see if I can get these trades to stick to the option chain mechanics and efficiencies and get some full profit. All right, what else? Japanese yen future still higher. Nikkei responding off the lows. FXY, I'm still long Japanese yen, so this is still benefiting from that. It's not up a ton. I'm up a couple $1,000. EWJ responding nicely. Did I get filled on both? Please tell me I get filled on both. EWJ, let me see. EWJ bought some at 61. So I got filled on a couple of these. So that one got filled, and filled. Because there was a buy around 71 and a buy around 61. So that puts me break even around 65. So sitting as a profit on EWJ, that's good if the Nikkei responds. Brazil, that's EWZ. DAX responding nicely as well. FTSE, okay, but I like DAX better. FEZ, I sold some premium. Should have sold some more premium, but I'm just good kind of hanging in there. Argentina, nice response off the 200 moving average. China, also responding nicely. EWZ has a long way to get above the 200 moving average. Latin America, same thing. MAGS, probably room to come back into the 200 moving average around 48 to $50. Apple, gapped up. We're at 205. I need Apple to stay above 190 this week. Let me check the options chain. Apple. Let me see. I should have some trades running on Apple. There is my ratio spread. So 195 by 190 ratio spread. It's up around 80% of max profit. Another one that I might just take and get rid of. So ratio spread. Naked puts out there to June. Those are okay. Covered calls. I'll continue to roll that for income. Yep. So I've got 1, 2, and 3 ratio spreads. Right now we're trading above. Let me see what the 190 looks like for this Friday. 190. It's before earnings. So we're on an 11 delta right now. Probability of staying above that is pretty good. I've got about an 87% chance of full profit. If it gets back into testing this 195 strike, there is a $5 profit trap there as well. So I'm going to let this one marinate for the week and see if I can close it out later on. If it goes higher, that's fine. I'll keep the full credit. But if it gets closer to this 195, 194, 193 zone, there's some bonus traps there that offers up maybe $600 or $700 per contract or per account. Okay, so I'm just doing some mag stuff right now. I'll get to currencies in a second. I see a lot of requests for currencies. Just chill with me. I'll get some trades going. Amazon responding nicely off the lows. Broadcom, same thing. Google, same thing. All my dollar cost average positions on Google are looking better. So we're back up to 161. I did a lot of trades around the 150 handle. See what Google looks like right here. Google is ratio spreads into May, June, and December. For some income. Meta, I'd like to see if Meta can come down into this yellow zone. I'm just going to wait a little bit longer. Hopefully it does. Hopefully we get some opportunities longer term for Meta around like 450 or 400. Microsoft responding nicely. This one, have a trade out to the 21st. So closed out 1, 2, 3 trades on Microsoft. So that was 3 for 3. Closed out profit there on Coinbase. Closed out profit as well. That was 1, 2, 3, 4 accounts. So 4 for 4 on Coinbase. Netflix. There is earnings on Netflix on Thursday, I believe. Thursday after close is Netflix earnings. To not take the risk, there is a butterfly trade up here that I put in. I'm taking the profit. I closed out for about 55% of max profit. So rather than sitting on earnings and watching this potentially gap higher, although it's a nice little trap up here, if somehow earnings like blows through the highs or the lows, I don't want to risk it. So I'm going to take the profit now and move on. NVIDIA back up to 112. You know, a lot of credits down here that I sold. Ratio spreads still looking okay. This 224 credit closed out for $155 on ratio spreads. NVIDIA still has some shares and collars. So have some shares. May is my collar trade, the 135 by 100. I sold a bunch of premium. Ratio spreads in the 50s. 70 by 75 naked puts, collar trade, still protecting profits. Naked put combo out to May. These are looking, you know, again, they're not like fully profit. There's just a lot of green. So because the premium was so high, I sold a bunch, you know, 75 and 70s, 55s and 50s. Other than that, I'm just kind of managing my collar trade for right now. Ratio spread, anything out to April. I don't see any April expirations. Clearest ones are ratios in May. Okay. Tesla 256. I had Tesla called away last week. So it got called away. Let me do the math on it. I think I made about $7,000 on Tesla on Friday's close. So 224.28. I was tempted to roll it, but that's going out another week right before earnings. 247.50 minus 224.28. Got it called away for 23.22. So I made 69.66 last week on Tesla. It took me about 3 weeks to do it, but I'd say waiting 3 weeks and making 7K is not too bad. I'm pretty happy with that little flip. Now this trade is done. So I'll say repair for 247.50 minus 224.28. Oops. So repaired for $23.21 per share profit. So it took a couple of weeks to hang on to it, but overall, happy with the repair. Now I've got a 1-1-1 trade as long as we stay above 255. Looking good for some profit this week. Hopefully Tesla has more recovery if we have a bullish week. Getting another one that gets back up at the 200 moving average. Not trying to be cute and fancy with it. Just take some profit if we're greater than 255. So it could be looking good there. Berkshire Hathaway. Look at that thing, man. Wow. Bouncing right off that 200 moving average. So fast. That's up 15% in 5 trading days. Right back to the highs. Meanwhile, bonds, so 1 to 3 year down, 1 and 7 to 10 year down, 20-year plus down. Yields, got to watch them, but yields are back above the highs of Liberation Day. So yields actually are worse off than when everyone was celebrating that we were below the 4 handle. That didn't do anything good. So the market still has the overall like bond market yields, what the Fed's going to do with rate cutting rates at some point this year, probably 3 to 4 times. Yields have just dug their heels in and they're not going lower. So yields are really, really sticky as global yields are rising, and it's affecting the U.S. 10-year as well. This has been one of the big the big gauges of the U.S. success is let's get the 10-year yield down so it helps on the liquidity air pockets, the refis. If you want to buy a car, buy a home, this 10-year needs to go down, and it has not gone down for the right reasons. Going down is because the market was crashing. Now the market put in a bit of a bottom. We're right back where we started. So very, very sticky stuff. Okay, I already talked about Bitcoin. It's fine. Still has a lot of grind to go, but there's really strong support at 75K. If we spend some time, it's all it needs. A little bit more time to stabilize right side of the trend line. Risk on gets Bitcoin hopefully back up to 108. Maybe a new rally to the upside would be exciting, but that would be a big risk on rally in my opinion. If we're not really there, I expect a bunch of noise. I could see Bitcoin being very noisy in here. Sideways, 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 sideways. Eventually, if it breaks, then it looks good. There's probably room to run. But lots of support around that 74, 75,000 we talked about. Okay, let's get some currencies, and then I'll let you go. Aussie CAD making a nice little comeback into this pocket around 8,900. Probably more to go. I just like Aussie CAD for the lows. Buy the lows, take profit at the highs. Even willing to dollar cost average into these lows at 82 and 8,100. I don't know if we're going to get there, but still being willing to kind of scale in and take some net profit. Aussie Swiss looking a little bit better. Big pockets here around 5,500. Positive swap. I'm going to wait and see. I want to move some of these buy stop orders down lower, but what I'm going to look for is, do I have a bullish pattern to trade? It's very possible that with all the shakeout here, we have this dump, this pullback, a revisit of the lows. This might be a bottom here to then trade, so I can get a little more aggressive at the lows. Or if we go dump here, maybe a fresh low with some divergence, and then we spot a pattern and then trade this thing back up into this resistance area. So these buy stops are likely going to get shifted lower. I'm just going to wait a little bit for some clarity and confirmation on whether or not I can kind of call this low area with some confidence. Aussie JPY, we breached the lows, but it's not a huge surprise that we did so with inefficiency. We did so with getting oversold conditions and the market's bouncing back. I still don't love the Aussie yen as a trade. Aussie New Zealand's, I'm just going to hang in there and just let this one ride out a little bit. Dollar, Aussie dollar. If anybody was long, so I've got some positions running. I bought it at 60.20. We're trading at 63. I think I'm just going to go ahead and take profit in this one. So 60.20 buy trade, closing out at 60.23. I'm going to take my 300 pips and move on. So 60.20 to 63.24. Let's take 320 pips out of that one. Or I guess it'd be 304 pips. I'll take the profit. Okay, so that was a plus 304. Buy at 60.20. Closed at 63.25. So 325 pips. Just taking the winner. What would I look for next on this one? Well, if we go from low to high and we chop around here, I wouldn't mind looking at some buy stop levels. If the dollar's going to get weaker and this Aussie benefits, from 64 to 6,900, that's a lot of open space on the Aussie dollar. But if it is, up here for recovery, chop, 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 moving back down to the lows, I'm not ready just to buy back in yet. So I'll take the profit. I'll move on. CAD Swiss, same thing, similar to Aussie Swiss. I've got buy stops up here that have not been filled. So I'm looking for, how can I spot some lows? If we're here chopping around, I'm going to start looking for bullish patterns to emerge, and I'll start shifting these lower, and then scale my way into a buy trade eventually on CAD Swiss. I'm looking to add more to it. CAD Yen, be careful bouncing off these lows. Wouldn't be surprised if it's range bound in the next few weeks. So just watch for some of that risk. Swiss yen, right back where we started. I would say, I'd stay out of this one. The only spot I'd look for on Swiss yen is if we turn hard here, or we go all the way back up to this high, we turn hard here. That's it. Like if it doesn't turn with confirmation or doesn't turn with confirmation, don't force a trade in this one. Euro Aussie, super volatile these last couple of weeks. This stock from this Forex pair from 63 to 1.85. That's over 2,200 pips of movement in the last couple of months, right? From February to now. Yeah, over 2,100 pips. Go to a smaller time frame. We obviously reacted a little bit off these lows. If there's a topping pattern, it's capable of pulling back into finding some efficiency. But with that much volatility, don't be surprised if price comes back up. And it may have been that little spike on looks like yesterday's high or Friday's high, I guess, is we may have tested the high and failed. So this position, right? You can see that's a little bit of a crown pattern. So we have lows, lows. That's a nice little swing opportunity. Pulls back deep. I would measure that to symmetry. There's probably some more direction to the downside. So when I say symmetry, I mean this. That swing to that swing. And there's still some room to get there. So there's probably another maybe 400 to 500 pips of bearishness if you're trading smaller time frames to get to that symmetry correction. Okay, Euro CAD. I would say, I don't know, be careful on this one. There is some divergence at the highs. If you're looking for an opportunity to short it, I like this overbought condition with divergence. So maybe if price comes back up here, look for some smaller time frame confirmation, trade it back down to this support. Probably a few hundred pips from like 5,800 down to 5,400, but trade that with some confirmation on a smaller time frame. Euro Swiss, similar to my other Swiss crosses, some buy stop levels here. If I can spot a better bottoming pattern, then I'll shift these lower and I'll trade these back up into this resistance zone. I still think this has room to get up to parity again. 1.00 is going to be my Euro Swiss target if I can hang on to it. But we have some pretty strong support. I just don't want to get stuck in some type of like, hey, I'm gonna get really heavy at these lows. There's no lows. Like this market might still just drift lower, drift lower, drift lower. Eventually, I do think the market will respond, and the Swiss has been strong enough for years. I don't know if there's going to be an intervention necessarily or manipulation, but if these lows hold, I could see us getting back to any of these highs. Get back to this high, get back to this high, get back to this high, switch this structure a little bit, trade it all the way back up to that range level. It's like there's technicals to look for on the bigger picture, but just this is why I'm keeping my trade size very small to not call the bottom. That way I can stay flexible. If I have to, dump positions, I can, but I think we still have some room to go up. Euro pound finally caught a trend. I mean, my gosh, this hasn't trended since a flash crash move in September. That was when the UK bond market broke. So, Euro pound just held really nice support around 8,300 and we're up 300 pips. Cool. That's about it. I'm not doing anything with it. I just thought it finally responded to the lows. I took several stabs at this Euro pound into the 200, into the 200, into the 200. I didn't hang on to that break to the upside. So it's fine. Euro yen, major support at 155, resistance around 165. You're in New Zealand, be careful. Watch your levels. Overbought conditions with diversion, similar to the Euro Aussie, maybe just selling back and finding some reversions. Euro dollar. Wow. Dollar index breaks the 100 handle. Euro dollar's up above 113. This is some open space. Look, to me, this is pretty enticing. If this is a wave 1, 2, 3, we could still be looking at euro dollar heading up into the 120, 122 handle. It might be an unpopular trade right now. We are sitting at very overbought conditions. I wouldn't want to buy euro dollar at these highs. I would want to pull back and get a swing first. Right now, like this low and this low, if this pulls back to a 38% or 50% or 618%, this swing looks pretty good to see if this is going to head higher. I don't know if you're going to get that trade. You know, if we're going to go up here and then bounce around and it's a little bit of a flag and it goes up higher, I mean, I suppose it's open space, but we're getting on a daily time frame, overbought conditions. I'd like to see a pullback. You know, so take this swing, look at your pullback levels, and see what lines up. And then if you buy it there, stop loss below, look for some symmetry. I think we can get up to 120. You know, but I want to buy it at like 110 or 108 to make that run, so I'm not risking a ton of pips to the downside. Pound Aussie, way more volatile than Euro Aussie. Probably just resettling a little bit. I'm staying out of these pairs. Some of these are just super volatile. Pound CAD, same thing. Pound New Zealand, same thing. Pound Swiss. If you've got the margin for it, I know Pound Swiss margin is a little bit higher than the others. It actually is at a pretty good spot to be just averaging in. I think Pound Swiss can come back into like 112 pretty easily. We just have to look for a bottoming pattern. Pound Yen, I'd stay out of that one for now. Pound New Zealand, it's resetting. You know, we went up, we're resetting, probably coming back into this 144, 200 moving average. Pound dollar, it's moving well. I mean, still supported by the trend line. I think euro dollar is a bit of a cleaner trade, but pound dollar could be revisiting this high around 34.40. If you're following shorter time frames, we're clearly in an uptrend right now. Buying a dip might not be all bad. New Zealand CAD responding nicely. New Zealand Swiss, again, buy stop levels. I'll be starting to shift these lower, see if I can get some new lows to get revisited, or this just starts making its way up, 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 takes out a low, pulls back here, give me a 3 to 5 wave move. And that's ultimately what I'm looking for a lot of Swiss pairs is if we have this capitulation move, we have a 1, 2, 3, 4, 5, and I'm dumping profit there. But this is a long ways away. You know, there's going to be wave cycles. It could be months in the making. So I'm just going to keep watching prices and just keeping the trade sizes small. New Zealand yen, building off that August 5th low. If you're taking a stab at that, it's not bad. But, you know, it also wasn't the low. You know, you look left on this chart, you're like, oh, that's a great trade. And then boom, it smashes you by, you know, 400 pips before it responds. So it was a tough trade. But right now, it's probably the pain has been felt, right? The retail crowd gets rushed out of it a little bit, and now it's a rebuilding. Maybe heading back up to that in this halfway zone. So if it stays shorter time frame confirmation to look bullish, I think there's room to trade it back up into the 200 moving average or so, maybe more. New Zealand dollar, nice rip. 5,500 lows. We're back up to 58.80, almost 5,900. Really strong support. That was a good technical level to buy and hold. So if anybody's holding the New Zealand dollar, that was a great trade. I was long at 56 and took some profit right before we had these previous highs. So I'm not hanging on to this any longer, but that was still a nice win for a few hundred pips. Is there open space? I mean, I hope so. I think this one has room if we go up here. Any pullback, you know, higher highs, higher lows. Maybe this goes up into 63, 6,400 if the dollar is going to continue to get weaker. Okay, dollar CAD. So pulled back into some nice resistance. In the short term, this may offer up some support. Oil really isn't showing any strength necessarily, so this is mostly led by dollar weakness. Oil's not really doing anything. I mean, CAD is giving back some gains. Aussie CAD is up. New Zealand CAD is up. CAD Swiss is still near the lows. I wouldn't be too aggressive on Aussie CAD. I could see it responding, but to me, this is almost a better trade if we go down to like 32, 31, or 30 again, as in like 1.32, 1.31, 1.30, and see if we do so inefficiently and then get a chance to trade this back into like some type of range. So either this thing turns now to head back up, or there's more, you know, dollar pressure, come back into major support and see if this turns back for another like 400 to 500 pip move. Dollar Swiss, pretty big breach of those multi-year lows. Again, if it's oversold with divergence, is it capable of pulling back into this cluster, this inefficiency, looking for a bottoming pattern to work its way back into that level maybe. We'll see what the manipulation looks like from the Swiss pairs. Dollar yen. Well, we didn't really have much of a right shoulder. Okay, not much of a right shoulder. But the yen is still, that pattern. High to low. This was a topping pattern that I was looking for an opportunity to short. It didn't pull back to the 50618 like I thought. That's why I was trading FXY. That's why I was trading 6J. I wanted to trade the Japanese yen strength with options. Also, they benefit from the dollar getting weaker and the Japanese yen getting stronger. So making money there. I would have missed my entries as a Forex trader waiting for the dollar yen to pull back to a 153, 154 handle. We just never got it. But we're heading back down towards these same lows from August of last year. So we could be looking at some near-term support on dollar yen. If not, measure symmetry. And that's what the yellow box is. So maybe down to like 139 or so. 140 is a round number. 139 is symmetry. So if you're currently short dollar yen, trend line break, bear flags maybe these last few trading days, I would just be moving stop losses and taking profits. Trail it. I don't think now is a good time to get into a fresh entry. Okay, and that's all non-US stuff, which is kind of put a pin in the non-US stuff because obviously when the US responded poorly to everything, the whole world caught a taste of it. So things are responding, but very disruptive markets here the last month. Okay, that'll do it for today. So I'm using this week, if we have some upside, I'm using this week to continue to raise some capital, increase my buying power on the stock side, option buying power side as well. All my expirations that I have going into this week. So Tesla, Q, SPY, Uranium, SLV, XSP, IBIT, Palantir. This one should be in profit for this week. That'll be like $4,000 on Palantir. UNG, some collar trades, Apple, IWM, KO, TKO, Copper. These are out a little bit farther, but the days to expiration, this is my window right here. So everything from TKO up to Tesla, managing these trades. I've already taken profit on Microsoft, taken profit on Coin. So this is a chance to hopefully see some profit for the week. Continue to add P&L, build up the year to date, raise some more capital and dry powder on the option buying power and stock buying side, and then continue to play defense and pick my battles. The Fed speeches today, you think dollar strength? No, Fed speeches don't really, they don't do anything. They're just I don't know what the Fed's going to say. All I'm looking, the Fed, you want to see Fed, look at the CME. This is all that matters. What the market cares about Fed-wise, what they're going to price in is probably related to this. So right now, May expectations is 0. They're not going to do anything. They're still going to hold rates. June, July, September. So we have 1, 2 cuts, maybe one by October, and that's it. So that's 1, 2, 3 cuts for the year. This has changed a lot. We went from 1 to 0 to 4, now to 3. So this is the cut window for the year. June, July, October. That's what it's looking like. CPI, PPI data came in better last week, came in softer. That's good. There was a nice little trend to the downside. Trueflation still showing, Trueflation still showing fresh lows on third-party inflation data. So that trend is good. But if we get sticky around here, let's see if we get into the low 2s on headline readings. What's headline CPI, what's core CPI, and stuff to watch for. But for Fed speeches today, I don't know what we have for major news this week. Barkin, Waller, and Harker. You got Barkin and Harker. Bet those names never get confused. I don't know what they're going to say. So, no, I don't think the dollar's really going to respond to them. I think they're more of like price stability. Make sure the market is satisfied. There's plenty of liquidity. Make sure there's nothing they have to be reactive about. This week, we have CPI out of Canada on Tuesday. We have CPI out of the UK on Wednesday. We have retail sales out of the US on Wednesday. Bank of Canada is looking to hold rates on Wednesday. Aussie employment this week. ECB looking to cut rates another 25 basis points. Unemployment claims out of the U.S. ECB press conference on Thursday. And we've got a Euro bank holiday for Friday. Good Friday. Are the U.S. markets open? So there might be some early closes on Friday. Honestly, that could be a good thing coming into the 17th expiration on Thursday. Is kind of a bit of a we survived the noise last week, and with that Wednesday rally, the market just kind of might stay in drift and offering up a little bit of bullishness into this major monthly expiration on Thursday. So I'm not seeing U.S. holiday here, but we're probably going to have some very, very low volume on Friday. Any traders in my like day trading services, we're probably not going to trade on Friday if the markets are open. I don't know. It could be one of those days where the markets are just going to drift higher. Low volume tends to drift if there's an absence of both parties, meaning like it's just buyers only, then the market drifts higher and everyone looks at it like, oh, that's a good thing. But if you're like trying to sell premium, it sometimes is challenging. So I'll probably be off on Friday. And we're going into Easter weekend. So, okay, I'll let you go for today, and we'll be back at it tomorrow. Thanks, everybody. See you. Bye.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. All month long, you can get the EdgeFinder 40% off, our best discount of the year. Check out the links in the description below to visit the EdgeFinder homepage, or speak with a team member directly to get the 40% off discount now. Trade safely, and we'll see you tomorrow.